Okay, well, good morning, everybody. Today we are going to discuss two important subjects. One is credit policy document, and then credit appraisal and approval memorandum. Both are important. We are going to discuss these two items today. In regard to credit policy document, actually, we would have most of the things we would have studied, we would have discussed already. But in the credit policy document, all these things would have been included. So the credit policy document is very, very important for a credit institution. So that's what we are going to look at it. Credit policy document. Actually, this is a document for the credit policy of the lending institution, which may be a bank or a finance company or a leasing company. So the credit policy document, when we say, it is about the credit policy of that institution. Credit policy document. All lending institutions should have their credit policy. They have their credit policy. So that is documented in the credit policy document. So the credit policy, why it is important? It establishes guidelines and principles for a credit institution, credit risk strategies and policies. So overall credit policy is very, very important because that establishes guidelines and principles for a credit institutions, credit risk and strategies that has to be followed by the personnel who are involved in the lending activities. So it aims to achieve one, a consistent, sound credit portfolio in the entire institution. A consistent, sound credit portfolio in the entire institution. And desired credit growth while managing the risk. So the credit policy of an institution aims two important things. One is a consistent, sound credit portfolio. You understand the meaning of sound credit portfolio in the entire institution, and the institution will have a growth. They have a plan for their credit growth. So desired credit growth while managing the risk. Okay. So now, all credit institutions, all lending institutions, all financial institutions will have their credit policy, and that is documented as a credit policy document. One institution is different from the other. So the policy also differ. We can't expect all the lending institutions will have a same credit policy. No. One institution will differ because we have already seen even the culture of the credit institution. Credit culture differ from one to another. Credit culture differ from one to another. So this credit policy, which creates the credit culture within the institution, also will differ from the one to another. So one institution is different from the other. So the policy also differ. Example, finance companies, they may have different credit policy. Small banks, then development banks for development lending. Large banks with all type of customers, all type personal customers, small and medium business customers, large scale corporate customers, SMEs, the type of large banks with all type of customers. So will they have their own credit policy. So different banks, different lending institutions will have a different, their policy also will differ. So all credit, but whatever it is, they may differ, credit policy may differ, but all credit policy document aims sound credit portfolio without any NPAs. So the credit policy document may differ from one institution to another. But the main thing, all credit policy documents aims sound credit portfolio without any NDA. Yeah, I must tell you an example. There was a development bank. So that development bank for development activities, lending for development activities. But the development bank thought we must promote exports also. Export also a priority area. Is a priority area as Sri Lanka is concerned. Export also priority area. So they want to help exporters. So they have developed a credit policy for trade financing. Trade, a development bank, which is not a commercial bank, but the trade finance facilities are provided by the commercial banks. But this development, so it is not a commercial bank, they want to promote exports with the help of commercial banks. So they want to join with the commercial bank and to promote exports. So for that purpose, they have developed a separate credit policy document for trade finance facilities also. But later, that bank, of course, amalgamated with another bank, and because of that, they couldn't proceed with that one. But I know they had it. So based on the policies of the institution, credit institution, they may have different credit policy documents. Right. Now we understand all lending institutions will have credit policy document, and we also understand that lending institution, credit institution will differ one from the another, so their credit policy document also differ. Now we come how these credit policy documents are prepared. How these credit policy documents are prepared. So it is a written document for uniformity within the institution. So each institution, they have a written document, credit policy. That's what we call it, credit policy document. Written document for uniformity. Senior officers of the institution with extensive experience in credit management discuss, prepare the credit policy, and then circulate among other senior officers. Actually, this function, this duty will be assigned to senior officers of the credit institution, the DGMs and AGM, senior officers with vast experience in credit management. So they will be assigned this job. So what they will do, they will put all their knowledge and experience and everything and prepare the credit policy document. So once again, written document for uniformity, senior officers of the institution with extensive experience in credit management, they among themselves discuss and prepare the credit policy document and then circulate among other senior officers. So other senior officers also will have the vast experience in credit management, lending, so they also put their thoughts. So if those are, if what they say also acceptable, if necessary, they amend it. They amend, but they have prepared the credit policy document, amend if necessary, and then finalize the credit policy document. So this is a modus operandi to prepare and finalize a credit policy document. Finalize a credit policy document. Then it has to be approved. So it should be approved by the CEO or the GM, depending on the position, and the board of directors of the lending institution. And then it will be circulated. So it will be an important document for the lending, the credit institution. And then another important thing, this credit policy, it should be flexible and updated periodically based on changes taking place. So once it is prepared, you can't expect it will be continue as it is. It is constant. No. Depending on the changes, it also will be amended changes. So it should be flexible for changes and updated periodically based on changes taken place. updated and then informed to the branches and the credit officers through internal circulars. Through internal circulars, it will be informed. So, how local international regulation may change, local regulations may change, international regulations may change, economic situation of the country may change, political environment may change, and then risk appetite of that credit institution. They want to go more and more for credit. So risk appetite of the credit institution, depending on that one, and there will be competition with the other lending institutions. So based on that one, if they consider all these changes, and the credit policy document will be updated, periodically based on changes taking place. So these are the changes. Once again, local and international regulation may change, economic situation may change, political environment may change, risk appetite of the credit institution, and then competition. Based on that one, it will be updated. And then it will be informed to the concerned credit officers, branches through internal circulars. Credit policies must be subject to directions of the Banking Act, Finance Act, and all relevant regulations. So when they prepare the credit policy, it is subject to the direction that all these things will be considered and the credit policy will be prepared. So Banking Act, Finance Act, and all other relevant regulations. And then direction issued by Central Bank of Sri Lanka. Periodically, Central Bank of Sri Lanka will issue direction. So based on that one, the direction issued by CBSL, Central Bank of Sri Lanka, and further international norms also may change. So international norms are essential guidelines in formulating the credit policy. So while formulating the credit policies, all these things will be taken into consideration. And financial institution may decide the maximum size of its loan portfolio. How much will be the total loan portfolio? That will be decided by the financial institution based on its deposit base, how much deposit has, what is the capital base, and other factors. Based on that one, they will decide what is the maximum credit portfolio. All these things will be taken into consideration while formulating the credit policies. Then another important thing in the credit policy, organization chart for credit function. Organization chart for, so all lending institution, credit institution, financial institution will have their organization chart for internal operation. For operation, they will have. Similarly, for credit function also, they have their organization chart. Credit policy document will outline the organization chart relevant for the credit function. So the credit policy document will outline how the organization chart for the credit function. You all know board of directors of the institution is the highest authority. Board of directors of the institution is the highest authority in the credit operation. Followed by, then there will be a board credit committee. Almost all banks have a credit committee. Below the board of directors, they have a credit committee. So we call it board credit committee. There are all senior officers of the bank, most of the important senior officers of the bank, DGM's credit, AGM's credit, other DGMs will be there. Then after that one, the CEO or the GM, board credit committee, and then the CEO or the GM. And then below DGM credit, and then AGM, then regional managers, area managers, and branch managers. So the organization chart will go like this. Please click your whiteboard, then you can see board of directors, board credit committee, then GM or CEO, and then DGM, credit, and then AGMs, credit, and then regional managers, then area managers, and then branch managers. So this will be the organization chart for the credit function. So top level, the board of directors, and then below it comes down to the branch managers. So now, the credit policy document will give this information. Board of directors is the highest authority, followed by board credit committee, CEO, DGM, credit AGM, regional managers, area managers, and the branch manager. This will be given. So each lending institution will have their own board. Among Kiva, make a whiteboard click Kiva. Okay, right. When I am doing, I am using the board, sometimes you may be not able to see clearly. So at that time, please click your whiteboard. Then you can see the whiteboard. I've already told. Right. Then the functions and responsibilities of these officers will be clearly described in this document. So this document also, they give the organization chart for the credit function and the functions and duties, responsibilities of these officers who are in this organization chart will be clearly described in the document. Okay, right. Then another important thing, delegation of authority. Delegation of authority. Now, the board of directors in the top position, even all the functions, including the credit function also, they are in the top position. So they can't handle all credit files. They can't give approval. So what do? They delegate their authority to the other officers downward. They delegate their credit approving authority, they delegate. Actually, all authorities are with the board of directors, but they delegate the approving level to other officers as according to this organization chart. So we call it delegation. Delegation, delegating the authority, delegation. So we call it delegation of authority. Each person involved in lending should know his or her authority limit to approve credit within the institution. Now this is the organization chart for the credit function. All these people will have their credit authority. They have their limit up to what extent they can approve the credit facility. They have their limit to up to what extent they can approve. So that is delegated from the board of directors downward. So each person involved in lending in a credit institution should know his or her authority limit to approve credit within the institution. This authority is delegated according to a person's position within the organizational hierarchy. So this delegation is done based on the position of the officers in this organizational hierarchy. So this authority is delegated according to a person's position within the organizational hierarchy. The credit policy document indicates authority of the board of directors, authority delegated to board credit committee, CEO or GM, and other officers in the credit approving hierarchy. So the credit policy document indicates what is the authority of these people have. It indicates. So once again, the credit policy document indicates authority of the board of directors, authority delegated to board credit committee, then CEO, GM, and other officers in the credit approving hierarchy. The amounts so delegated are reviewed annually. So once the authority amount delegated, it will be reviewed annually. It will be reviewed. And again, circularize internal circulars, as I told you earlier. So delegation of authority also stated in the credit policy document, one by one. So earlier we have seen organization chart for credit function. We have seen the credit policy OK, organization chart, and then now delegation of authority mentioned in the credit policy document. The GM or CEO of the institution will issue letters to individuals of their credit authority limit based on position, experience, credit knowledge, etc. And then GM, as I told you, the GM or CEO will inform the relevant officers of their delegated authority, of their credit authority. The GM or CEO of the institution will issue letters to individuals of their credit authority limits based on their position, experience, and credit knowledge, etc. But one thing, consequence of violation of delegated authority limits are described in the document. That also described. Sometimes some officers may go and approve more than their delegated authority. Sometimes some officers may approve credit more than the authority delegated to them. So those are violation of delegated authority. Violation of delegated authority. So the consequences of violation of delegated authority limits also described in the document. They do such thing, yeah. What is the outcome? That also described. The deliberate violation of this authority will lead to disciplinary action. So violation of the delegated authority, deliberate violation of this authority will lead to disciplinary action. There may be inquiry, and if it is proved, there will be disciplinary action. Procedure to be followed in exercising the authority, exceeding authority in case of emergency, obtaining covering approval are also included in the document. Okay, now, so branch manager is there. He has to approve. He has to, one customer wanted a facility, maybe 10 million rupees facility. That branch manager do not have that authority. It has to go to his next, maybe area manager or the regional manager, or maybe to the AGM. But it is so urgent. The customer is very good customer of the bank, but other officers are not available at that moment. So because of the urgency, this branch manager can approve exceeding his authority. But procedure to be followed in exercising the authority, exceeding the authority in case of emergency, obtaining covering approval are also included. So in that case, the branch manager has to obtain a covering approval from the relevant highest authority. From the relevant authority, covering approval, by giving reasons. By giving reasons, he has to obtain the covering approval. So that procedure also described in the credit policy document. That also described. In case due to emergency, if he approves, how to obtain the covering approval. That also stated. Then delegation of authority linked to collateral also. If this is the collateral, so what is the delegated authority for that particular officer? Authority to allow credit without collateral also included in the document, especially TODs. Temporary overdraft is a credit facility given to the customers, best customers, There are, of course, no collateral, generally no collateral. Sometimes manager may obtain joint and several guarantee of some other people, but generally no collateral in the case of TODs. So that is without the security. The details how to grant that facility also, it is stated in the credit policy document. Authority to allow credit without collateral are also included in the document. Example, TOD, how to grant TOD facilities. That also mentioned in the credit policy document. Then the pricing policy in lending. Pricing policy. Pricing policy means what is the interest rate charge on lending, credit facilities. The lending institution should maintain a uniform pricing policy for lending to various customer segments. You are aware, in one branch, one rate for one particular facility, in another branch, another rate, another lending interest rate for the same type of facility? No. The lending institution should maintain a uniform pricing policy for lending to various customer segments in the entire institution, considering its cost of funds, administration, cost and risk factor is a basic thing. So the lending institution should maintain a uniform pricing policy for lending to various customer segments in the entire institution, considering its cost of fund, administration cost and risk factor. So there may be fixed interest rate or variable interest rates. So lending interest rate also, there can be fixed rate or variable rates. The types of facilities subjected to those rates are also included in the document. For what type of facilities you can charge fixed rate, fixed lending interest rate. For what type of facilities you can charge variable lending interest rate. That information that also included in the credit policy document. And pricing can be linked to prime rates. So what is the prime rate? Yeah, AWDR, average weighted deposit rate, average weighted deposit rate, or AWPLR, average weighted prime lending rate. So these rates, actually, these are calculated by the central bank every week based on the commercial bank lending, various commercial bank, what are their lending rates, how much they have lent, what are their lending rates for various facilities. So central bank collects all this information and do the analysis and publish in the papers these prime rates. Every week central bank publishes their prime rates in the papers. So we call it AWDR, average weighted deposit rate, that is based on the deposit. Average weighted prime lending rate, that is depending on the lending rates. So both the central bank collects the deposit interest rate as well as lending interest rate. So separately they do the analysis and publish. And so the pricing can be linked to these prime rates. Pricing can be linked to the lending institution for their best corporate customer. They can offer, okay, we can give you 1% above the prime deposit rate, or we can give you 0.5% less than the prime lending rate. So they can negotiate with the best customer. So pricing can be linked to prime rates or treasury bill rates also. So this information also included in the credit policy document. So the pricing policy also included in the credit policy document. Pricing policy is clearly stated when credit facilities are considered against the borrower's deposits with the institution. There is another category. Borrowers may have their deposit with the institution. They may have the fixed deposit, or they may have saving deposit, and the borrower may may like to take credit facilities against their deposit with the lending institution. Against their, yes. So in that case, what is the interest rate the lending institution is going to charge from the borrowers who have their deposit with the lending institution? That also included in the credit policy. What percentage can grant out of the deposit? What percentage can be granted by way of credit facility? And what the interest rate to be charged? All those information also mentioned in the credit policy document. So the credit policy document in regard to all aspects of lending is given how to do, what to do, all the information, detailed procedures are given in the credit policy document. Then the portfolio mix. Portfolio mix, credit portfolio mix or lending portfolio mix. An institution loan portfolio can be mix of all sectors. So generally, a lending institution, a large scale lending, big lending institution, they have lending to various sectors. Commerce, trade, agriculture, industries, fisheries, tourism, various sectors. So an institution's loan portfolio can be mix of all sectors. But sometimes, it can limit the sectors, it can advance within it. So some bank, they may limit the sectors. Some branches of foreign bank, they limit the sector. They are not lending to agriculture or industry. They are lending for the trade finance, they are lending. And for consumption facilities, they are lending like that. So some credit institutions, some bank, they limit to what sector they are going to lend. Whereas others, they are lending to various sectors. So an institution's loan portfolio can be a mix of all sectors, or it can limit the sectors it can advance within it. It can limit. So both are possible. We have seen now some big banks, they are lending to almost all sectors. But some banks, especially branches of foreign banks, they are lending to only certain sectors. To maintain a balanced portfolio, it can decide the amounts to be advanced to each sector, whereas the banks or lending institution, they are lending to various sectors. So to maintain a balanced loan portfolio. So it is important for them to maintain a balanced loan portfolio. It can decide the amounts to be advanced to each sectors. So that institution will decide how much they can lend to each different sectors in order to maintain a balanced portfolio. So in deciding the sectoral exposure, institution will consider, so they have to decide what amount they have to lend to various sectors. So for that purpose, in deciding the sectoral exposure, institution will consider regulatory guidelines. Yeah, central bank regulatory guidelines. Actually, the central bank regulations are there, directives are there. For the priority sectors, certain percentage of the lending should go. Here, in all the commercial bank, certain percentage of their lending should go for the priority sectors like agriculture, industry, housing, fisheries, exports. These are the priority sectors. So certain percentage should go for these priority sectors. Right, regulatory guidelines. So the bank has to decide what amount they must maintain the portfolio for various sectors, how much they have to. So that will be depending on regulatory guidelines. Then their priorities. They also have priorities. Then political authorities, political situation also. Then the geographical location of the institution. Now, some banks, they may have in certain areas, maybe hill country, among tea estates, right? So their priority sector and their situation, their geographical location may tend to grant more facilities for the estate sectors, like that. So geographical location of the institution. All these things taken into consideration, the institution will decide how much exposure they can go for each sectors. So thereby they maintain a portfolio mix. Now, balanced portfolio. Portfolio mix is a tool to mitigate credit risk, which we have already told. Do not keep all eggs in one basket. If anything happened to the basket, you will lose all eggs. So you must keep the eggs in different basket. If one thing, something happened to one basket, all other baskets of eggs are there. You won't lose. So because of that one, we call it balanced portfolio is an important thing for a credit institution. It is a tool to mitigate credit risk. It is a tool to reduce the credit risk. So major sectors considered in credit policy are major sectors, which we have already seen: commercial or trade, then financial, lending to financial institution also there. Big commercial banks will lend to other financial institutions also. Agriculture, tourism, industrial and other manufacturing concern, housing, SMEs, others. So these are the various sectors considered by the credit institutions. How much to grant to these each sectors based on the things I have already told you. So thereby maintaining a portfolio mix. Balanced portfolio. Balanced portfolio. Similarly, even the short-term, medium, long-term loans also, they have to maintain a balanced portfolio. All these information are given in the credit policy document. Then, customer and the market segmentation. Customer and the market segmentation. Lending institution also will have their market segmentation. So this document, the credit policy document, will define the bank's market segments and the criteria for such segmentation. What are the, so the bank, the lending institution credit policy will describe what are the market segmentation for that bank, for that particular credit institution, and the criteria for such segmentation, how they identify or they separate these market segments. So importantly, the corporate segment, middle market segment, retail segment. Almost all commercial banks have these market segments. The criteria, how to segment this one, the criteria may be annual turnover, total asset, a number of employees, etc. But mainly the annual turnover and the total assets of those institutions are the major criteria for the segmentation of the customers or the market segmentation based on annual turnover of that customer or the total assets of that customer. And then different policy framework can be used for different segments. So different segments to cater to the different sectors, the different credit policy also may have. They may have a different credit policy framework to cater to the corporate sector, to cater to the middle market sector, to cater to the retail. They may have. Different policy framework can be used for different segments. The evaluation process, method of pricing, and collateral requirement will also be included for these different segments in the credit policy guideline, credit policy document. So once again, the different policy framework can be used for different segments, that is for corporate or middle market or retail, and the evaluation process when they are considering credit facilities for these segments, the evaluation process, method of pricing, what is the lending interest rate chargeable, and how is the collateral requirement, also will be included in this credit policy document. So when a corporate customer comes, yes, how you will evaluate, how to evaluate, what is the interest rate you can offer them, and what are the collateral requirements will be included in the credit policy document. Similarly, a retail customer come, yeah, how to evaluate his requirement, how to give his, how to charge the lending interest rate and the collateral requirement, those information also included in the credit policy document. And then another important thing, prohibited or discouraged credit facilities, which also we have learned earlier in our programs. Prohibited or discouraged credit facilities. The details and the information about this also included in the credit policy document. An institution does not entertain certain type of credit facilities for various reasons, and that also included in the credit policy. So that depends on the individual credit institution. So an institution does not entertain certain type of credit facilities for various reasons, and that also included in the respective credit policy of that institution. Legal, cultural, religious reasons. Yes, there are some institutions, they consider this legal, cultural, and religion reason for certain activity. They are not lending. It is there in their credit policy. Then advances for illegal purposes, yes, totally prohibited. Manufacture and trading of narcotics and firearms, yes, totally prohibited. So all these things are included in the credit policy document. Borrowers and guarantors, then another category. Borrowers and guarantors listed as defaulters in the CRIP. In the CRIP report also come under this category. So they also prohibited. And the procedure to be followed in this situation also included in the credit policy document. But in case if there is somebody good customer, unfortunately he got figured in the CRIP, how to? So that procedure also included in the credit policy document. Once again, borrowers and guarantors listed as defaulters in CRIP reports also come under this category, that is prohibited or discouraged credit facilities. And the procedures to be followed in this situation also included in the credit policy. Then applications of borrowers who do not provide required information as per bank policy will be rejected. If any customers, if they are not giving the relevant information to the bank, that is the policy of the bank, that they must collect all these important information. If any customer or the borrower is reluctant, their application will be rejected. That also they are in the credit policy document. Then minors and persons with unsound mind. Minors and persons with unsound mind will also be in this category. And the procedures to be followed are also included in the policy document. So all these information are there in the policy document, credit policy document. Then collateral and documentation. Collateral and documentation. Each type of credit facility and the collateral acceptable to the institution for such credit facilities and the procedures to be followed in each category are included in the credit policy. So each type of credit facility, various types of credit facility, the banks are granting, and the collateral acceptable. But are the collateral acceptable to this constitution for such credit facilities? So if the customer wants some long-term loan, long-term credit facility, then of course bank will definitely ask a property mortgage. The collateral should be a land and building, a property mortgage. So that information also included in the credit policy. Okay, for such collateral, what is the procedure to be followed? What is the procedure to be followed to accept that type of collateral for that type of credit facility? That also included in the credit policy. Then purpose of granting short-term and term loans are also explained. So why we have to give short-term loan, short-term facilities, why term facilities, that also included in the credit policy document are also explained to safeguard the lender's interest and to ensure enforceability of collateral in case of default. So all these details are given in the credit policy document. Collateral and document. What type of collateral you can obtain for a particular type of credit facility, how you have to document it. All these details is given in the credit policy document. Then, how to obtain various types of securities, collaterals for credit facilities are included in the credit policy. How to obtain various types of securities or collaterals. So what are the type of securities or collaterals for credit facilities are included in the credit policy document. So we are obtaining, these lending institutions are obtaining various type of securities or collateral. Cash deposits, government securities like treasury bills or treasury bonds, life insurance policies, shares in quoted or unquoted companies, stock in trade, movable, immovable assets, book debts, pledge, and guarantees and indemnities. These are various types of securities or collateral. So how to obtain? How to obtain these various types of securities, collaterals for credit facilities? How to obtain? All included in the credit policy document. Then procedures to be followed for proper registration of mortgage bond. And certain cases, you have to register. Mortgage bonds, you have to register. Where to register? In the case of land and building mortgage bond, you have to register with the land registry, land registry. If the customer is a company, you also have to register with the registrar of companies. Within how many days you have to register? Within 21 days from the date of execution, you have to register. So all these information are given in the credit policy document. How to register? Procedures to be followed for proper registration of mortgage bonds. Then TR documents, pledge documents, yes, and assignments, various assignments are also included in the credit policy document. All other documents needed, such as letter of offer, yes, in the case of lending, the documentation is very important. So all other documents, apart from these mortgage bonds and other things, that has to be registered. Apart from that, other documents you have to collect, you have to obtain like letter of offer, agreements, bonds, guarantee bonds, like that, also indicated with legal requirement. What are the legal requirements? All those information, it is included in the credit policy document. So now you see from A to Z, everything in regard to providing the credit facility by a credit institution is given in the credit policy document. A to Z, everything. What type of credit facilities that particular institution is granting? So for that one, for what purpose that particular institution is granting credit facilities, for what and what purposes they are granting, relevant to those, all the information from A to Z is given in the credit policy document. Then, credit monitoring and follow-up. Credit monitoring and follow-up. Procedure for credit monitoring and follow-up are included in the document. So once after granting the facility, you have to follow up. Monitoring is an important thing. We generally say pre-sanction and post-sanction supervision. Before granting the loan also, you have to inspect to see what and what things are there. Pre-sanction. After sanctioning, after granting, after approving, post-sanction supervision. So collectively call it credit monitoring and follow. The important function of a credit institution. Credit institution. That's what we generally say. When a facility is appraised, well appraised, you can be sure half of the loan is repaid. If the appraisal is good, half of the loan is repaid. The balance half, depending on your monitoring and follow, credit monitoring and follow. So procedures for credit monitoring and follow are included in the document. That also included the procedure for monitoring and follow in the document. Periodical review of credit facilities, necessity for customer visit, obtaining periodic reports from customers, how to identify deterioration of credit are also included. So yeah, all these information are included. Periodical review of credit facilities, periodically how to review the credit facilities. So there is central bank instruction also direction to review the credit facilities periodically. So periodical reviewing of credit facility, one thing. And then necessity for customer visit, why you have to visit the customers, obtaining periodic reports from the customers, how to identify deterioration of credit, how to identify deterioration of credit. That's also included in the credit policy document. Then downgrading of customer rating and the recovery procedures also outlined in the document. If the customer's conduct is going bad, then downgrading of customer rating, and if the customer is defaulting, then recovery procedures. All the information are outlined. How to do that one are outlined in the document. If the credit facility is to be restructured, procedures to be followed, as well as delegated authorities for such action also included. Now, if the credit facility is to be restructured, some credit facilities are defaulting. Credit facility granted to a customer is defaulting. So after doing various inspection, discussions and other thing, if the authority, if the lending institution think it has to be restructured, how to do the restructuring? If the credit facility is to be restructured, what is the procedure? What is the procedure to be followed? As well as the delegated authority for such action. The delegated authority for restructuring. That also included in the credit policy document. If a NPA to be rescheduled, there is a non-performing advance, defaulted advance, non-performing advance. If it is to be rescheduled, either with a capital low interest waiver, sometimes the banks may give a capital waiver, interest waiver, or sometimes the capital waiver for rescheduling purpose. So if an NPA to be rescheduled with a capital low interest waiver, the maximum amount of concession that can be allowed under each authority level and the procedure also included in the credit policy document. Rescheduling with interest or capital waiver. Then how to do it? What is the procedure? And what is the delegated authority for such thing? That's also given in the credit policy document. And the person responsible for maintaining security document, then person's role in safeguarding the institution's interest, that also included. So now the security documents are kept in the safe custody. the person responsible. Who is responsible for maintaining security documents, also given in the credit policy document, and the person's role, his role in safeguarding the institution interest, also included in the credit policy document. So almost now you understand, if you go through your credit policy document, you can learn a lot of things by going through your respective your institution credit policy document. You can learn many things. Okay. Now non-performing advances, NPAs. Procedure to identify NPAs. How to identify the procedure? How to identify the procedure to identify NPAs and the action to be taken thereafter after identifying. So what sort of action you have to take, and the accounting procedures are included, also given in the credit policy document. Then provisioning policy against NPAs, provisioning policy against NPAs, considering the period of credit facility was in default, also included, subject to regulatory requirements. So how to do the provisioning based on the fact how long this facility is in various NPA section, that also included, but subject to regulatory requirement because the central bank directions are there. So subject to the central bank directions, how to do the provisioning or impairment loss, how to do that procedure also given in the credit policy document. Then, based on prevailing legal requirement, the procedure to be followed in instituting legal action against each collateral also explained. So in case when you are going for the recovery action, when you want to take legal action, so based on prevailing legal requirement, the procedure to be followed in instituting legal action against each type of collateral also explained in the credit policy document. How to do the legal action, instituting the legal action, depending on the various types of collateral, but depending on the legal status, prevailing legal requirement. That also given in the credit policy document. Then how to file legal action against clean or unsecured facilities like TODs, unsecured facilities. How to file legal action and secured facility and the responsibilities of the relevant department and units also explained. So how to file legal action in the case of clean facilities or unsecured facility, and similarly the secured facility, how to file and who is responsible, which unit is responsible, that also explained in the credit policy document. Procedures and approvals required for parate action and after auction also explained in the document. About the parate action, what is the procedure to be approved, what is the procedure to be followed, from where the approval should be obtained for the parate action, and after auction, what is the procedure, everything explained in the credit policy document. If new facility is to be granted to a defaulted customer, that also there. Totally not refusing facility for a defaulted customer, but the bank can consider if new facility is to be granted to a defaulted customer to revive the business, the procedures to be followed also included. So there is a procedure for that also, but that has to be followed. If you want to consider a credit facility for a defaulted customer in order to revive his business, there is a procedure that also there in the credit policy document. Then credit audit. This is also there about the credit audit. There's a separate chapter in the credit policy document for credit audit, outlining credit audit requirement and its aim. So there's a separate subset in the credit policy document for the credit audit. So it is required to ensure compliance with the credit policy and the regulatory requirement. So you must look at both credit policy and the regulatory requirements. So it is required to ensure compliance with the credit policy and the regulatory requirement. Quality of credit granted, follow-up and supervision, skill level of credit personnel, and training needs are the scope of the credit audit. So while doing the credit audit, they will look into the quality of credit granted, how the follow-up and supervision, and apart from that, skill level of credit personnel in the particular branch, the skill level of credit officers, the credit personnel in the particular branch, and the training needs are also the scope of the credit audit, and they will recommend after doing the credit audit at a particular branch, and they will see whether such and such credit personnel need training, in what areas they need training. So they will recommend. So quality of credit granted, follow-up and supervision, skill level of credit personnel, and training needs are the scope of credit audit. Annual review of credit granted is an accepted policy of financial institution, and the audit team verifies adherence to this requirement. Annual review of credit granted is an accepted policy of financial institution. The financial institution should ensure that annual review of credit granted is done. So the audit team will verify whether this is adhered to, this duty is adhered to, this requirement is adhered to. The audit team will look into this one also. So this is credit audit. Then the risk management. Credit risk management procedure of the lending institution is an important part of the credit policy document. So credit risk management also given importance in the credit policy document. Credit risk management procedure of the lending institution is an important part of the credit policy document. It is a duty of the risk management team to ensure that the bank maintains diversified and quality loan portfolio to the bank. So there is a risk management team, risk management department. So they have to ensure that the bank maintains diversified and quality loan portfolio for the bank. Accordingly, the duties and responsibilities of the risk management department in controlling the credit risks of institution are included in the policy. That also included in the policy. Accordingly, the duties and responsibilities of the risk management department, what do they have to do in controlling the credit risk of the institution, are included in the policy. Okay, now, word of advice to credit officers. Word of advice to credit officers. Now, so we have seen, up to now, we have seen the credit policy document. First, we have seen what is credit policy document, who will develop this credit policy document, and thereby what are the important things included in the credit policy document. So now you may understand that the credit policy document of an institution, credit institution, it includes almost A to Z of credit function, everything. So it is given how to do the procedures and everything. Procedures and everything is given in the credit policy document. So, a word of advice to credit officers. What is that? All officers involved in lending operation within an institution. All officers involved in lending operation within an institution must thoroughly review the credit policy document approved by the board of directors of that institution. So they must thoroughly review the credit policy document approved by the board of directors of the institution and understand all the guidelines comprehensively and be familiar with this document. So you credit officers, you all are you want to perform your duties in credit functioning. So you may be credit officers, credit managers, you may go up in your rank in your institution. So all officers involved in lending operation within an institution must thoroughly review the credit policy document approved by the board of directors of that institution and understand all the guidelines comprehensively and be familiar with this document. Ignorance of the credit policy is detrimental to the organization, as any deviation can result in serious violation of the law of the country or regulation issued by the regulator. Sometimes the regulators, the central bank, will give directions. So if you violate that one due to your ignorance, then it is detrimental to the institution. So ignorance of the credit policy is detrimental to the organization, as any deviation can result in serious violation of the law of the country or regulation issued by the regulator. Besides, the lending institution will be unable to recover credit facilities due to the negligence of the credit officers as a result of violating the credit policy. So, if a credit officer violates this credit policy, sometimes the institution may not be in a position to recover the facility granted to the customers. So, you must be well aware of your credit policy by going through the credit policy document. So this is the word of advice to credit officers. You can go through because it will be there in all branches, all banks will have their credit policy, and periodically it is amended through internal circulars. That's what you must always try to see, the internal circulars issued by your bank. Okay, so this is the credit policy document. Now we have come to the end of this program. You have already learned a lot of things. All these things have been included in this credit policy document. Right. So one is now I have completed the credit policy document. I have completed that one. You understand the importance of credit policy document. If you all are working in a particular bank or a credit institution, you must know what is in your credit policy document. You must go through and make it thoroughly, and you must follow it. Then only you have a strong credit culture in your institution. You will have a strong credit culture in your institution. Thereby, the community, your customers, the employees, all employees will have a faith and trust on your institution. Right. Now we move on to another subject. Preparation of credit appraisal and approval memorandum. Or some banks call it preparation of credit appraisal memorandum. credit appraisal memorandum. Some people, they call it credit appraisal and approval memorandum because it is for both. Appraisal also done and send it to the highest authority, 11 authority for the approval. So we call it credit appraisal and approval memorandum. So how to prepare the preparation of credit appraisal and approval memorandum. Now we have already learned this one, credit appraisal process. It may be a consumer credit, maybe a personal loan or a housing loan. It may be a small business loan, small or medium business loan, or it may be a corporate credit, corporate facility, or it may be a development facility, project for an SME. We have already learned. The credit appraisal process we have learned. So now in a common way, if you are putting, first you will collect of data and information about that particular customer and the venture. You collect data and information about the customer and the venture, about their business. Then you analyze it. You analyze it. We have seen the 5 C's method, Campari method, and pass papers method, 5 pillars method. We have seen for the evaluation or appraisal of credit facilities for various purposes. So analysis data and then conclusion. Analysis means you appraise or evaluate and then you conclude, come to the conclusion whether to grant or decline. Whether to grant or decline the facility. So if you decide to grant, then what you have to do, you have to structuring a suitable credit package. You have to structure a suitable credit package for that customer. And then prepare a credit appraisal memorandum. Prepare credit appraisal and approval memorandum or credit appraisal memorandum you have to prepare. And then you have to submit this memorandum to the relevant authority for the approval. So this is the credit appraisal process. So once again, you collect a collection of data and information that is from sources of information. You collect various sources of information. We have learned in our past sessions, you have learned sources of information from various sources. You collect data and information about a particular customer. Then you analyze those data and information. Then you will conclude whether to grant or decline. If you are granting, what you have to do, you have to structure a suitable credit package for that customer. And then you prepare a credit appraisal memorandum. You have to prepare. And then you submit the memorandum to the relevant authority for approval. So this one. So now we are in the process of now, in case if you are granting, structure a suitable credit package, prepare credit appraisal memorandum, submitting to the relevant authority for approval. Now that's what we are going to do today. Now, structuring a suitable credit package. Now, various credit facilities are available from lending institutions for borrowers. Now, lending institutions, especially commercial lending institutions, commercial banks, various credit facilities are available from lending institutions. So now the credit officers should select a suitable credit package to fit the borrower's requirement. So now the credit officer should select a suitable credit package to fit the borrower's requirement. In the case of consumer credit, that means personal loan or housing loan, it is straightforward. Personal loan to purchase a car or purchase a TV set, loan. Medium-term loan, it is straightforward. Or housing loan, a housing loan, straightforward. Elaborate package is not necessary. Similarly, In the case of small and medium business loan, also it may be straightforward. They may want a business loan to purchase item for trading purposes, or they may want a hypothecation loan to meet their working capital requirement. Straightforward. In the case of small and medium business loan, also it may be straightforward. But in the case of a project loan, the starting everything, project loan or corporate lending, proper credit structuring is very, very essential. So in the case of project loans or corporate lending, proper credit structuring is very essential. And the credit officer should offer best appropriate credit products to the customer. So the credit officer must see what are the facilities will suit this particular customer's requirement. So he has to identify, he has to select such facilities and make as a package and provide to the customers. If there is a fault in structure in this credit package, that also may be a reason for the failure, or maybe a reason for default of repayment of facilities. So credit structuring also very important thing, like the evaluation of the credit proposal, appraisal of the credit proposal, and finally the structuring of the credit facilities, also credit package, also very important thing. So, but in the case of project loans or corporate lending, proper credit structuring is very essential. And the credit officer should offer best appropriate credit products. It may include direct as well as indirect credit facilities. You may know. Now, please click your whiteboard. Please click. I am going to use the board. So, the last sentence, it may include direct as well as indirect credit products. Direct as well as which we have learned already. So, direct means funded facilities, indirect means non-funded, non-funded. So, here in this case, direct loans, overdrafts will purchasing or discounting. Here, guarantees and bonds. The loans, short-term loans, then term loans, so many short-term loans, term loan. From there, of course, maybe mortgage of movables, mortgage of immovables, pledge, GR facilities. We have seen so many facilities we have seen. I hope you can see that. GR facilities. Hypothecation facilities. Hypothecation. I will write hypothecation. Facilities. Revolving credit. Or series of loans. Packing credit facilities. Various types of credit facilities. In the ODs, GODs, and then permanent ODs, PODs. Then bills purchasing and discounting. It may be a check purchasing. Check. Or discounting. And international bill purchasing. Discounting. And here, so many different guarantee bonds, even payment guarantees, letter of guarantee, that is letter of guarantees, even letter of credit you have learned in international module. Letter of credit you have learned, that is importer's bank is promising the exporter's bank to send the goods and the bank will pay them. Bank is promising that it will pay if they send the goods to the importer. So that is letter of credit, that is also guaranteed. Letter of. So there are so then bridging finance. Bridging finance, and then foreign currency loans, foreign currency facilities, foreign currency loans. So these are so many facilities are available, especially with the commercial bank. Especially with the commercial bank, so many facilities are available, funded as well as non-funded. So from these facilities, the credit officer should select the best suited for the customer. He must select the best suited for the customer and grant that facility as a package. I told you in the case of a consumer credit, it is straightforward, just a loan to purchase a car or a purchase a house or housing loan, straightforward. Even in the case of a small and medium business loan, maybe they want a hypothecation loan to purchase the goods, or they want a loan by mortgaging their property to construct their shop building. Because it is straightforward. But in the case of a project, there are so many activities, or corporate, there are also so many activities. They need different types of facilities to fit them, to match their requirement. So the credit officer should select the best and form as a package and provide it. That's it. But in the case of project loan or corporate lending, proper credit structuring is very essential, and the credit officer should offer best appropriate credit products out of this. Appropriate credit products out of this. It may include direct as well as indirect credit products, credit facilities. Okay. So, structuring suitable credit package. Structuring a suitable credit package. Now, for your information, I have written this. I will erase it now because I want to use it again. The whiteboard. I am erasing it. All these things we have studied. We have studied all these things in our earlier program, lecture program. We have gone through it. Now, the credit officer must thoroughly understand the project or corporate customer's requirement. That is, the project investment detail and what is the debt and what is the equity. So that you have to discuss with the project people or the corporate customer, and you must decide. So in this case, here's an example. Land, a project loan. The land, the worth is they valued 25 million. That is borrower's equity. That is borrower's equity. Then the land development have to be done. Maybe leveling and various things, and parapet wall or live fence they have to put around the land. So land development, 5 million. So this also borrower's equity. So 25 plus 5, 30 million is borrower's equity. Now they have to construct a factory building, 35 million. Other buildings, maybe factory building, then there may be an office, or there may be quarters for the managers or the supervisors, quarters, 15 million. Then the machinery, there is a machinery has to be imported, 20 million. Then the machinery, local, purchasing locally, 10 million. Then motor vehicles also named, the appraisal of appraised and see the requirement motor vehicle is justified, 15 million. Then the working capital, that also based on the cash cycle they have worked out, 20 million. So total is 145 million, the project cost. So in a simple way, we see how you can structure the suitable credit package for this one. So land and land development 30 million, that is from the borrower's equity, and the balance, yes, you have to provide credit facilities for these customers. So you have to provide a suitable credit package. Now, in structuring a suitable credit package, it is general rule that lending institutions expect the borrowers to use their contribution first. So now, generally, almost all banks, they want the borrower's equity should come first. So in this case, the land is there, okay. And the land development also we have allocated as per the appraisal, it is 5 million. Okay. That has to come from the customer. It is general rule that the lending institution expect the borrowers to use their contribution first. So land and the land development, that has to be come from the. So let us assume the project to purchase local raw material, processing it, and market the product locally. So in this example, we assume, let us assume the project to purchase local raw material, processing it, and market the product locally. On the other case, if the project purchase local raw material as well as import raw material and then processing it, market locally as well as exporting, then yes, you have to consider trade finance also for the importation of raw material and for the export of products. The trade finance facilities also will come in. So now we are not going to handle, include that one now. So you have to first understood the basic one, you have to understand, and then you have to develop it. Now we are learning. Now you are learning. So we go from the very basic one. Then you can learn about the trade finance facilities, how to provide the trade finance facilities for this project. Right. So now let us assume the project to purchase local raw material, processing it, and market the product locally. So the trade finance facility won't come into this example now. Then construction of building. Yeah, long-term facility we have to provide. Long-term facility we have to provide. Yes, construction of buildings. Then purchase of machinery. That can be provided with medium-term facility. They can repay that one. But one thing, this is depending on the cash flow. So that also you have to carry out, you have to analyze and see whether the machinery, when the grant facility to purchase the machinery, whether they can, I'm just going back, machinery 20 million and local 10 million. Imported one 20 million, local one 10 million. So whether from the cash flow analysis, which you have done into a financial module, whether this can be granted, whether these two facilities can be repaid, within 5 years time, whether these two facilities can be repaid. But in the case of factory building, yes, based on your cash flow, they need a long-term finance. So in the case of other building, local building, in the case of machinery and imported as well as local, purchased locally, they can repay in the medium term. Right. So purchase of machinery, medium term facility. Then purchase of motor vehicles, medium term facility. Alternatively, lease facility to purchase machinery and vehicle also could be considered with the consent of the customer. So when you discuss with the customer whether you want a loan facility or a lease facility to purchase the machinery or to purchase the vehicle, with the consent, you can alternatively you can consider. So once again, now we go. It is a general rule that the lending institution expect the borrowers to use their contribution first. That is, land and land development should be done by the borrower first, and then only the bank can go into financing. So let us assume the project to purchase local raw material, processing it, and market the product locally. Right. Now the construction of buildings, that is factory building as well as the other building, long-term facility. Based on the cash flow. So that analysis you would have done. Cash flow analysis you would have done. So based on that one, long-term facility. Then purchase of machinery, imported machinery as well as local machinery, medium-term facility. Purchase of motor vehicles, medium-term facility. Alternatively, lease facility to purchase machinery and vehicle also could be considered with the consent of the customer. Right. So now we are structuring. Now we are structuring the credit facility. So this is a very easy package, credit structuring package, right? So you can do it. Term loan facility for the construction of building, rupees 50 million. So one is 35 million for the factory building, 15 million for the other building. So total 50 million. So term loan facility for the construction of building, rupees 50 million. One credit facility. Then the overdraft for the working capital. For the working capital. There are other facilities also you can provide, but overdraft, because it is revolving. It is revolving, permanent overdraft facility. So permanent overdraft limit of rupees 20 million. That is equal to working capital. Revolving for the working capital. Right, other facility. Now, one machinery has to be imported. Maybe from India or China or Japan. One machinery has to be. So for the importation, the supplier, the purchaser, importer negotiated with the exporter, that's a supplier of the machinery, and he has agreed on a letter of credit basis. Letter of credit basis. And then it has to be letter of credit also under you have learned under your international module about the letter of LC facilities you have learned. So whether it could be site, that is immediately you have to pay, or whether there is a credit facilities given by the supplier term, but generally the site. Okay, so letter of credit facility, it may be site or term, limit of 20 million to import machinery. That facility also you have to do. That facility also you have to do. So the other facility, that is letter of credit facility, site or term, limit of rupees 20 million to import the machinery. Right. Then you should know that letter of credit facility, LC facility to import. This your importer's bank promising the exporter's bank, you send it, we will pay. Okay, after machinery coming, to retire the LC, the money has to be paid. To retire the LC, the money has to be paid. Either that money should come from the customer's pocket or bank has to provide a facility. Yes, medium term of 20 million rupees to retire import bills on machinery imports. This is one-off limit. One-off limit means only once for the importation of the machinery. After that, this is clear. So medium term of rupees 20 million to retire import bills. That is importation of machinery on machinery import. This is one-off limit. So once that is paid, that is clear. LC facility is clear. Right. LC facility. So actually this should come. The one-off limit should come above. The one-off limit should come above. That is letter of credit facility, site term, limit of 20 million to import machinery. So this is wrong. This one-off limit cut and put this one-off limit above the letter of credit facility, site or term limit of rupees 20 million to import machinery. And the medium term loan of rupees 20 million to retire import bills on machinery imports. Right. And then locally also machinery has to be purchased. So another facility, medium term loan of rupees 15 million to purchase machinery locally is another facility. Then to purchase a motor vehicle, the customer would have agreed for a lease facility. So a lease facility of rupees 15 million to purchase a motor vehicle. So this is a simple credit package for this project. So this we have structured from the available credit facilities from the institution. We have structured once again term loan facility for the construction of building rupees 50 million. That is construct the building, factory building plus the other buildings. Then overdraft limit of rupees 20 million, that is revolving permanent overdraft for working capital requirement. to meet the working capital requirement. So working capital, that also you would learn in this program, that is revolving. That is revolving. So to match that one, the permanent overdraft facility, the balance will, when they withdraw or utilize, yeah, the balance will go up, the debit balance will go up, and then when they put the money, so it is revolving. Right. Then letter of credit facility to import the machine. Either site or term facility, it is based on the customers, based on the negotiation with the exporter. It can be site or term. Limit of 20 million to import machinery. This is one-off limit. This is one-off limit. That is, once you are using it, thereby it is, after that it is cancelled. After that it will be cancelled. Right. Letter of credit facility. Then medium-term loan facility of 20 million to retire the import bills under the LC on machinery import, to retire the bills. Right. This one-off limit, please cut. Right. Then medium-term loan of rupees 15 million to purchase machinery locally. And then lease facility of rupees 15 million to purchase motor vehicles. So this is a very simple structuring of a credit package for this project. Keep it in your mind, if this project is importing raw materials, processing it and exporting, then other trade finance facilities you have to provide for the importation, for the export, everything. So your structuring will be somewhat, it will be complicated. In the sense, you have to do it. You have to learn and you have to do it. Right. Now we come to credit appraisal and approval memoranda. Okay. Now the time is 10:25. We go for a small break. And we meet here by 10:25, by 10:35. We meet by 10:35. Okay? Okay, right. Hello? Good morning. Yes. Mama, කොළඹ ඉන්නේ අද. කොළඹ ඉන්නේ. අද මම ලෙක්චර් ප්‍රෝග්‍රෑම් එකේ ඉන්නේ. ඉවරෙච්ච ගමන් මම කෝල් දෙන්නම්. Okay, right. We meet by, okay, yes, 10, 25, 10:40. We meet by 10:40. Let us continue. After deciding the credit structure, the credit officer will prepare the credit appraisal and approving memorandum as per the format used by the institution. Each institution, for this purpose, credit appraisal and approving, they have their own format. Each institution. So there is no uniform for all the banks, all the lending institution. There is no uniform format. Each lending institution will have their own appraisal memorandum. So after deciding the credit structure, what credit structure or the credit package, what facility the bank can grant for this purpose, the credit officer will prepare the credit appraisal and approving memorandum as per the format used by the institution. Each credit institution uses its own format to maintain uniformity within the institution. In the case of SME credit lines, all participating credit institutions use a common form. So when there is a credit line, especially SME, now there is an SME credit line is implemented. There are various participating banks. They all use a uniform format for the appraisal and approving purposes. They use a uniform format. So in the case of SME credit line, All relevant and basic information should be incorporated in the memorandum to facilitate the approval process. Actually, the credit officer is preparing the credit appraisal memorandum. So in the memorandum, all relevant and basic information in regard to the project or the corporate business and the credit facilities should be incorporated in the memorandum to facilitate the approval process. As approving authority make credit decision, so the relevant approving authority make the credit decision based on the information provided in the memorandum. So the approving authority won't visit the project or the corporate to see what and what things are there. No, he is looking the project or the corporate business through this memorandum. So this is through this memorandum only he visualizes what is the project or what is his corporate business. He visualized through this memorandum. So all important and necessary information which are relevant should be given in the memorandum. As approving authority make credit decision based on the information provided in the memorandum, it should be brief, concise, and provide all the required facts and figures. So the credit officer should provide only relevant information and the facts. Now, an approving authority may be an AGM. So AGM for an area, maybe for a province, AGM. So he is the final approving authority within the province. So how many branches are there? From all those branches, based on the approving limit, credit authority limit, so many applications, appraisal memorandum will go to him. So he has to go through all within the speculator, within the time frame. So only the relevant information should be given in the memorandum. Then only he can go through and visualize and make it credit decision. Unwanted things should not be given in the memorandum. So the preparation of this memorandum, credit appraisal memorandum, is a skillful matter. You need a lot of skill. You learn a lot of things by preparing more and more memorandum. And thereby only you learn what are the important things, relevant things. It should go in the memorandum. So you have to learn it. You have to learn it. So it is skillfully prepared. It should be prepared skillfully. So the credit officer should provide only relevant information and facts in the approval or appraisal memorandum. Keep it in your mind. Credit appraisal and approving memorandum. So the memorandum should consist of the following areas. There should be a credit limit summary. Then the basic information sheet of the applicant. The applicant may be individual, partnership, or a small private limited liability company, or a public company, a corporate customer, yes. And then associates concerned with the applicant. So maybe in a group of companies, the associates concerned and their relationship. Then the insurance. Insurance, actually all project assets, 11 assets should be insured. So those details you must give. Then the request, what you are requesting your approving authority. What you are requesting the approving authority. You must give. Then the background of the project or the corporate business, the background you have to give. The current, under that one, the current status, competition faced by the company and its strength, who are the key personnel in the management that you have to give. Then the financial condition of the company, that is the profitability, liquidity, leverage, debt and interest cover, and then comments under each item. So this you have already learned in your financial module. In financial module, past financial statement analysis, the ratio analysis you have done, thereby the profitability, the liquidity, the leverage, then debt interest cover ratios, and based on that one, your comments under each item you have to give. And then evaluation of collateral and its suitability. Then profitability to the bank. By granting this facility, how far the profitability to the bank? So you have to give the profitability to the bank by this facility. Then risk analysis. And what are the risk mitigation factors? Then what are the special conditions based on the risk? What are the special conditions you are proposing? Then finally, your recommendation. Why you are recommending this proposal? So all these things should come in the credit appraisal and approving memorandum. All these information should come in the credit appraisal and approving memorandum. So now, the number of pages may about 3 or 4. It should not be more than that. So you have to develop the skill to give the important, relevant things in a suitable way. So it won't exceed the number of pages. Then it will be more cumbersome for the approving authority to go through. So you have to give the exact what are the important, relevant things in your memorandum. And your memorandum should consist all these items. So first we look at the credit limit summary. Now we have seen what are the facilities we are granting for this customer. We have seen what are the facilities we are granting for this customer. So credit appraisal and approving memorandum, I short form memo. So first one, limit summary. Credit limit summary. You have to give credit limit summary. So there, who is the applicant? Registered address. Registered address you must give. Then the branch from where it is going you must give. Then there is risk rating you must give, and what is the date? Then the review, when you have to do the review again. Now the risk rating, you have already learned there is an internal risk rating. In bank, they have to internally risk rating their customers. Before granting the facility, at the time of reviewing, when there is default reviewing, yes, internal credit rating. You have to rate internal credit rating. That has to be done. So this is a risk rating. And then review. When is it? The review. Right. Then the review. Again, date. Review date. Right. Now, reference heading. Reference. Facility type. What are the facility type? Present limit. Present limit. I will explain why it is. Why it is. I will explain why it is. I put this review date. This restating, when it is reviewed, when the restating was taken, that day, then now the review date. Right. Now, reference, facility type, present limit, outstanding, then proposed limit, then funded or non-funded, facilities whether funded facility or non-funded, then interest or commission, then purpose of facility, then security and repayment. These items are included in the credit limit summary. Once again, the reference number, then the facility type, present limit, outstanding, then proposed limit, then funded or non-funded, what is the interest chargeable or the commission, then purpose of the facility, security and repayment. Okay. So now, why this present limit is outstanding? In case of a new facility, when the first time when the customer is getting the facility from the bank, then it won't be there. If the customer already obtained the facility from the bank and still that facility is going on, that has to be shown. If the customer already taken a facility, that facility is still going on, now he is coming for another additional facility. So the earlier facility we had to mention. What was the present limit? Facility, right? What is the present limit of that facility if the customer would have taken the facility earlier? So in this case, it's a new project. So there is no earlier facility. Right. So fund, reference number 1. So POD, permanent overdraft. We are giving for the working capital. It is revolving. Present limit nil. Now we are going to grant. Right. No. Sorry. We are going to grant. Yes, it is nil. It is outstanding nil. Proposed limit. So how much we are going to grant for the overdraft? Overdraft limit 20 million. 20 million. Proposed limit 20 million. 2.0 ml, 20 million. Fund or non-funded? Funded. It is funded. Interest rate and commission? Yes, put. What is the interest rate or commission? You give. What is the interest rate applicable? You give. Purpose of facility to meet the working capital. Working capital. Purpose to meet the working capital. Purpose to meet the working capital. Now the security. So for this one also they are taking mortgage. Mortgage over project assets. Project assets. Mortgage over project assets. Now this one is permanent overdraft facility. Permanent overdraft facility is allowed permanently as long as. So the repayment on demand. Repayment on demand. If anything goes wrong, the bank can demand the repayment. Otherwise, if everything is going on well, it can go on. Repayment on demand. So this is the first facility. So credit limit summary. So we are giving what are the credit that's package. Right. One is PO. Now second one. Yes. We are going to establish an LC. LC. So with the supplier discussed, it is a site. Site LC. It's a site LC. LC for the importation of machinery. So present limit nil, outstanding nil, proposed limit how much? Owed how much? Letter of credit facility 20 million. That is also 20 million to import machinery. So this is what, funded or non-funded? Non-funded. NF. Fund is not moving. Interest or commission for whatever it is, you have to put it. Purpose of facility to import machinery. To import machinery. To import machinery. Security now the documents. Documents under bank control. Documents under bank control and joint and several guarantee of directors. Joint and several guarantee of directors. So this is LC site. So here you have to say one of only one facility. After that, yes, there is no more LC facility to import the machinery. This is to import the machinery. So one is So this is LC, site LC, only for the importation of the machinery. Present limit, no. Outstanding, nil. The proposed limit, 20 million. It is non-funded facility, interest or commission, whatever it is put to import machinery, and no document, documents under bank control, joint and several country officers, self-liquidating. So when it comes, it is liquidated. Then third facility, term loan. So nil loan, earlier here is no loan, so nil. This is also nil. Facility is how much? Term loan. Oh, this is to retire the LC, so 20 million. 20 million. This is funded. Interest, yes, term loan mentioned. To retire the LC. To retire this LC. So when the item comes, has to be paid, and then collecting the document, clear the items. So to pay this LC, now the loan is granted, term loan of 20 million to retire the LC. So what is the security? Joint and several guarantee of directors, and because mortgage over, all project assets have been taken, and 60 monthly installments, repayment, 60 monthly installments, repayment, 60 monthly installments, right. Now, fourth one, term loan. Now, for the working capital we have given, importation of the machinery LC established, to retire the LC and the term loan is given. Now, next one. Machinery, to purchase the other machinery, 15 million. Term loan, nil, present limit, this is 15 million. This is also funded. Interest rate, yes, you put it. To purchase machinery locally. To purchase the machinery locally. $60 monthly installment, yes. So this also security, joint and several guarantee of directors and 60 monthly installments. 60 monthly installments. This is to purchase machinery locally. 60 monthly installment. Now the next facility, yes. So for the working capital POD, to import the machinery LC facility, to retire the LC term loan facility to 1 million. Now to purchase machinery locally 15 million. That also term loan, 60 monthly installment. This also 60 monthly installment. Now the building, construction of building. That is also long-term term loan. Present limit nil, outstanding nil. Proposed limit for both, how much we have allocated? Medium term loan. Rupees 50 million. 50 million. This is also funded. Interest rate, you just put it. This is to construct buildings. Construct building. This is also joint and several guarantee of directors. This is also long term, say about 7 or 8 years. 7 or 8 years. So if it is 8 years, based on the cash flow. This is based on the cash flow. So and 108 monthly installments.
Just confirm.
Right. I will repeat it. Yeah. So 108 monthly installment. This is for the construction of the building. Now, the next facility, to purchase the vehicle. So we provide lease. Customer has agreed lease facility. Present limit nil, proposed limit outstanding nil. How much? No lease facility. 15 million to purchase the vehicle. This is also funded. Rental. This is rental. These are repayment. Here, interest. So this is rental. To purchase, to lease, not purchase, to lease motor vehicles. Then security, absolute ownership. Absolute ownership of the vehicle by the person. Then guarantee of joint and several, guarantee of 2 directors. Maybe the period, that is medium term 5 years. Fine. So this is the limit summary. I repeat it once again. So credit appraisal and approving memorandum. The first one, you have to give a credit limit summary in that one. So in that one, first you will mention applicant. Who is the applicant? The detail, their registered address, from which branch this proposal going. Then risk rating of the customer, internal risk rating. We have already studied that this rating one, and when was it done, the date, then when it will be reviewed, the date you will give. Then the heading, reference, the facility reference, then the facility type, what is the present limit, what is the outstanding of the present limit, then what is the proposed limit, how much you are going to grant, whether it is funded or non-funded, then interest or commission, how much, and purpose of facility, for what purpose you are granting, then security and repayment. So these are the facilities, these detail you have to provide. First one, we have decided credit structure POD. It is revolving. Present limit, we haven't granted this facility yet, so present limit nil, outstanding also nil. Proposed limit 20 million we are granting for working capital. It is funded. So interest on commission, whatever the possible one, you have to put it here. You have to put it here. Then purpose, to meet the working capital. To meet the working capital. Right. Then security and repayment. The final column, security and repayment. So what is the security? Mortgage over project assets and repayment on demand. Repayment on demand. Right. Then LC. Site LC to import the machinery. It is one off. Only one time it will be used. Present limit nil, outstanding nil, proposed limit 20 million, non-funded, interest or commission you put it, to import machinery. Then documents under bank control. LCs, the document will be under bank control. Joint and several guarantee of directors. And then repayment, self-liquidating. When it is cleared, payment of cleared, then it will be liquidated, self-liquidating. Then term loan, next one, yeah, you are providing a term loan to retire the LC. So present limit nil, outstanding nil, proposed limit 20 million, it is funded, interest commission you will put to retire the LC, for the payment of the LC. Then joint and several guarantee of directors, then 60 monthly installment. This loan will be repaid in 60 monthly installments. Then another facility term loan, that is present limit nil. Since the present limit is nil, outstanding also nil, then 15 million. This is to purchase machinery locally. Funded, then it is interest commission you put it to purchase machinery locally. Joint and several guarantee of directors, 60 monthly installments, repayment. Then another term loan, present limit nil, outstanding nil, proposed 150 million. This is also funded. Interest or commission, whatever it is, you mentioned that one, to construct the buildings. Then several joint and several guarantee of directors, 108 monthly installment repayment. It is almost 9 years long-term loan. 108. Right. Then finally, lease facility. Present limit nil, outstanding nil, proposed limit 15 million. It is also funded. It is interest. So now here you have to mention rental. The rental, yes, and then propose the purpose of facility to lease the vehicle. Then absolute ownership and joint and several guarantee of directors. Then repayment 5 years. So this is the limit summary you have to give. If there are any other in the credit packages, if it is import and export, trade finance is involved, then those things also should be, so you have to learn it yourself and you have to. Now the basic thing, the limit summary, how to prepare the limit summary. I have given you. So this is the limit summary. And then, so first you have prepared the limit summary. Here you have to mention precondition. Precondition you have to mention. So this limit summary, so there will be a precondition. What is always the letter of offer? The bank, when it is granting the facility, the bank will issue a letter of offer, and that should be accepted by the customer. So these facilities will be released after the letter of offer, acceptance of the letter of offer, and then all the security documents should have been executed. All the security documents should have been executed, and after that one only the fund will be released for this purpose. So it's a precondition for the release of funds. All the security documents should have been completed and executed, and then in addition the letter of offer should have been issued and accepted. Should have been issued and accepted by the customer. Right. And the second one, what I have given, basic information sheet. The second one is the basic information sheet. Shall I erase this? I will erase this.
Excuse me, sir. So regarding that 50 million facility that for the term loan, can we
Sorry,
additionally take for the 50 million
Please repeat
facility? For the 50 million facility,
Yeah.
in addition, can't you take a property mortgage as well, sir?
Yeah, that is actually property mortgage. It is already stated first, so it is applicable for all facilities.
Okay.
50 million facility, yes.
In addition, only we are taking the director's guarantee, right, sir?
That's right, but already we have all project assets have been taken. Yes, actually, yes, yeah, 50 million. Other apart from the project assets, other mortgage of other assets have to be taken. Yes, you are correct. You are correct. The 50 million facility, property mortgage. It should be a property mortgage. You are correct.
So that should be mentioned in the credit report, sir. In the credit limit summary. Should we include that in the credit limit summary?
Yes. It should be.
Okay, sir. Right. Okay, sir.
Basic information sheet. So, in the basic information sheet, you must give applicant, the name of the applicant and those details you must give. The constitution, then nature of business, date, incorporated, or registered, then account number, date account opened, check returns, balance during last 6 months, facilities taken, and the institutions from where the facility is taken. These basic information. In addition, any associates concerned, that is, any associate companies or subsidiaries, those information. So this you have to give the basic information. The basic information sheet you have to give. Then, in addition, director's details. Director's details. Director's details. Name of the directors, the address, what they are doing, and number of shares, value of the shares, and whether there are any foreign participation, all these information you have to give. So this is the second one. The basic information sheet. If the associates, if they have taken any facility, if they have taken any facilities, those details should be given. Those details should be given. Right. Right. So this is basic information. That is applicant and the associate concerned and the licensee. Second one, basic information. Okay, I am going to erase this. Now, next one, insurance. We are doing the insurance. Now, the questions, yes, there is a mistake. The working capital, we put mortgage over project assets. Okay, somebody asked me a question, mortgage over project assets. So this is applicable to all the credit, all the loan facilities. So this mortgage over project assets, we are taking the mortgage over project asset, that is land, building, machineries, all those things. So that applicable for the all loan facilities. So if I have just mentioned joint and several guarantee of directors. Apart from that, please mention there mortgage over project assets. So what are the facilities we have considered? Overdraft limit that I have already put, mortgage over project assets. Letter of credit facility, no, that is only this one. The medium-term loan to retire the LC, mortgage over project asset, and joint and several guarantee of directors. Then medium-term loan of 15 million, joint and mortgage over project asset, and joint and several guarantee of directors. And the term loan of 50 million for the construction of building, it is mortgage over project assets and the joint and several guarantee of 2 directors. It is clear that mistake is done. It is corrected now. The person who asked me that question, are you there?
Yes, sir.
You are there?
Yeah, yes, sir.
It is clear now?
Yes, sir. Thank you very much.
Yeah, please include that one. I made that mistake. I'm sorry. I
Okay.
Yeah, for all those loan facilities, mortgage, because the mortgage over project asset has been taken, that covers all the facilities.
Okay, sir.
Please, right.
Okay, sir. Thank you.
Right. So now the insurance. So here, assets insured, value, value of the policy, risk covered. What are the risks covered? Valid till and policy number. One, buildings. Value of the buildings. Buildings. Value of the building, 50 million. Risk covered, strike, SR, riot, civil commotion, and fire and floods. Value, valid till, no, that is of course still not obtained. To be obtained. Then machinery, machinery, what is the value? 20 plus 15, 35 million. This is also do same. This is also do. Strike, riot, civil commercial. Strike, riot, civil commercial. And then fire and floods. Here we put to be obtained. To be obtained. Policy number still not. This also to be obtained. Machinery. Then vehicle. What is the value of the vehicle? 15 million. Then this is comprehensive policy. Vehicle comprehensive. PRE comprehensive policy. This also to be obtained. Right. This is insurance. So that's the next item, insurance. Then, so one by one, first you are giving the credit limit summary. How to give the limit summary, I have explained. Then there is a basic information sheet. There about the applicant and the associate, the relevant information that also I have given what information you have to give. And then insurance, what item you are going to insure, the value of that item. So that we have given. And after that one, we are still preparing the credit appraisal and approval memorandum, memo. Then the request. On the request, you have to make the request. So there what you have to give, you have to give the background of this project or business background. Of the business or the project. And if it is a project, they would have given you a project report. In the project report, you would have studied and verified and you have done it. So the important thing you have to get it. The important things from about the importance of this project or importance of this business you have to collect. Then current status. Current status. Of the industry or business, current status. You have to give it. Then competition. How about the competition? How this industry is affected? How this is affected? Then strength of the industry. So you are going to, actually, if you are satisfied with the project or the business, you have to give the important points to the appraisal officer. He must go through it. He must see. The request. So here you have to give the background. Actually, I have mentioned this one. You have to give the background. So in the background, you are going to give the current status. Competition faced by the company and the strengths. How is the strength? Then Key persons. Key persons. So you are giving the background. This is coming under background, so I am raising this background. So current status, the industry, status of the industry or the business, the competition, how this is affected, then what are the strength of the industry, the key persons. So this is very important. If it is one man show, if anything happened to the man, then the industry will get affected. Business will get affected. So that you have to see in the appraisal time you would have seen, and that you have to mention. So who are the key person? If there are, then there should be a follow-up program. That is, when this man goes, there should be another person to take over. That should be already there in place. That should be there. So if it is there, you have to mention key persons. Then the financial conditions. Then the financial conditions you have to. Financial conditions. If it is a new project, if it is a new venture, there won't be any past financial statement. There won't be. But if it is already existing one, then you have to give the financial position. Now, financial condition. You have to mention about profitability, liquidity, leverage, debt, interest cover. You have to mention. This you have already studied in your financial module. They have covered all these things in your financial module. So based on that one, all those things you have to give. What you have analyzed, profitability ratios, and then liquidity ratios, leverage ratios, debt interest cover, and you have to give your comments also. And you have to give your comments. That is very important, which you have already learned. Which you have under financial module, you have already learned. So those things you have to give it here. Right. And then evaluation of collateral and its suitability. Evaluation. The next one, evaluation of collateral and its suitability. Yeah. So what are the collaterals you are taking? Here, the project land, project buildings, and machineries. Yes. And you have to mention. And when you mention how far these are suitable for this project, as a collateral, the suitability. So land and building, those are long-term assets. So for the long-term lending, they are matching. Like that, you have to mention the assets, profitability. Sorry, evaluation of collaterals and its suitability. And then profitability to the bank, the next item. Profitability to the bank. So there, you are charging interest, you are charging commission, how much you will earn from each facility, and what is the fund you are using. So are you granting based on the prime rates based on that one you are giving, or normal interest, cost of fund basis you are giving. So what is the margin available? How much profit you will earn? The profitability. You have to give. How far it is profitable to the bank. You have to do this calculation and you have to mention. And then risk analysis and risk mitigation factors. So what are the risks in this in this lending, what are the risks you are envisaging. So those things you have to mention. And how are you going to mitigate those risks? You have to mention. Then the special condition for you. Those special condition, if you have any special condition, you have to mention that one also. And finally, you have to give the recommendation. In the recommendation, rather than giving in view of the above, we recommend this. Generally, people are saying like that. In view of the above, we are recommend this. No. Categorically say for what and what thing you have to say. If it is important for the country's economic development, you mention that one. Since this project or this venture is important for the country's economic development, and then whether it is culturally or socially acceptable to the people, and if there is a ready market, all those information. So on what basis you are recommending? So mention all those things, and finally you say, in view of this, we are recommending. So this is the way you have to prepare your credit appraisal and approving memorandum. So when you do it, about 2, 3, 1, you do it, you will get it. But the format, each bank will have their own format. So my advice, from your bank, please collect a format. From your bank, please collect a format, how they prepare this format. And go through it, and then you will get more ideas about how to prepare this appraisal and approval memorandum. Especially for the corporate one. Especially for the corporate one will be it should be, because the amount also more, because of that one, that is very important. So with this one, and I must tell you, this is actually, you have learned all these number of months, various things in this diploma in credit management. Finally, everything comes into this preparation. Finally, everything comes into this preparation of this credit appraisal and approval memorandum, because it is the one going for the approval purpose. So this is very important. You try to develop yourself, and even I think examination point of view also, this is important. This preparation of credit appraisal and approval memorandum. So you must master this one. If you have any doubts, you can give me calls and ask. If you have any doubts or anything, you can speak to me over the phone. Right. I hope, and once again, that correction, I hope you all have noted it. This the security, that is mortgage over project assets, that will go with all the loan facilities. I have missed that one. Yes, I have missed that one. One person has corrected me. Yeah. That is there. Please include when you are writing. Please include that one. Okay, I am concluding this one. I think this is going to be your last lecture. You are going to have your exams very soon. I hope, I wish you all very best in your exam. Okay, thank you. Thank you very much.